Good day. Ira Epstein with your agriculture update for this Monday. And we are now on February 10th, 2020, and we're about 1:45 p.m. Central Time. You know, I'm watching certain markets to get a feel for what's going on. Let me give you some logic. I'm watching markets such as coffee. People are going back to work in China. Not a large amount of people, but people are going back. So let's assume it's 10, 20, 30% of the workforce in Beijing. Let's assume that it's a different number wherever it's at. My point is, in areas where people are starting to go out, the question is, will a market like that get a bid? You might say, well, Ira, if that's the thinking, why are energies down? And the energies are down because you've got the threat of Libya coming on board, 1 million barrels a day. The field that Saudi and Kuwait have operated and stopped operating together in 2015, they have resolved their differences. They're going to start a test run on that of 10,000 barrels a day this week and go to 500,000 barrels a day. You've got the situation where Russia doesn't want to join in with OPEC, and you've got the question of what's going on in the stock markets. So we know the coronavirus. We know we're all going a little nuts in the head because we get different stories all the time. We know the numbers go up a little bit, they go down a little bit, but what hasn't gone up are the mortality rates. They're nothing like the SARS virus. All I'm saying is you got to keep this all in perspective. In America, we're so used to the flu. We're so used to a large amount of people, unfortunately, passing away. As this moves on, maybe those people don't get the flu the way that we have, and the question is, what does it mean? Now, when I come to the grain market, I'm watching how the grain market is starting to anticipate, I think, tomorrow's USDA reports. We're going to get the idea of what the supplies are out there. The question is, when does demand come on? We heard in our firm that the crushing plants in China are coming back on operation now. And we've heard that they're running anywhere from 10 to 30% operation. By the end of this week, could be 50% or even higher than that. Eventually, you've got to get grain back into the, if you will, into the supply chain for them, for the animal feed and so on. Things we have to think about. Do I know when it's going to happen? I know as much as the man on the moon. But I'm just reading so much and I'm learning from that and I'm getting a feel. When I look at this chart, my eye goes to the fact that we have an approximate, on a closing basis, support zone in the 870 area. It was, if you come to this close right here, and that was the close of January 31st, it was 872.5. If I come all the way back to this close, that was 876.75. So I'm going to be content saying, okay, the market's trying to find its way there. That is not bullish. It's just where the market's trying to find support. Certainly, if you get and close under the 870s, that could be a failure zone and you could go lower. Where's the bias? To the downside. You're under the 18-week average of closes. Next, we come to the daily bar chart. We know we had a breakout from this point. The market went all the way down here under the 870 level in the March beans, and since then, we're getting a consolidation, even a mini attempt, if you take a look at it, and moving back to the upside, because as of the close today, we have a pattern of higher lows and higher highs. The second thing that we have is looking at where resistance is, and I contend it's at the 18-day average of closes, which is 896 3/4 or so right now. And that number is slipping down a bit each day. It's moving down about 3 cents a day, as you can see. So it's going to be closer probably to the low 890s tomorrow. When we look at the Bollinger Bands, the market is through with this type of vertical break that it had, and it's gone sideways since then. So that's after the fact, but what's going on? And today an important event to me happened. You lost the embedded reading on a closing basis. You can get it back the next day after you lose it. That's the only time you can get it back. Otherwise, it's got to rebuild. But when it's lost, the projection from that is that price and the 18-day average should make a run at each other unless it's regained tomorrow. Therefore, I think at the end of the day today, you saw the pros coming out of short positions. I think they act ahead of the time. They can always say, I'll jump back in if I have to. Meal, same thing. You lost the embedded reading, and if we come back here to Friday, you can see it was embedded. You lost it, and it basically got up to that number. It missed it by 20 cents. I mean, 2 ticks, the very minimum. My guess is it'll hit it tomorrow. Unlike beans, it has a pattern of a lower low, higher high, but the theme is there. Is that it for this leg of the break? That's all that my theme is, but it's an important theme. Now, with the meal up, I would have thought oil would be down today, and it was. Remember, the spreaders, as they come back in, it's rare that they're buying the beans, the meal, the oil, unless it's right after a new set of fundamentals come out. Otherwise, they're always looking at the crush spread, and if you don't get a big move one way or the other, that's what they're playing. So that's what I think they were doing. I think we have resistance back at 31.66, and I think the market has a shot of going there. Why? If we come back here to last Tuesday, February 4th, the next day you lost the embedded reading. That often leads to price and the closest of the moving averages making a run at each other. You hit it right through here, as you can see. From there, you backed down. You didn't have to hit the 18-day average. You hit the 100. It's the closest. So now the question is, does the market lay down here, or does it want to come up if the rest of the bean complex goes? In the corn market, I see momentum has flattened out. The market is starting to fight a battle at this 18-day average of closes. If tomorrow's report's a little friendly, it's possible that you rally into that to the 100-day average. If it wants to break, I'll look to see where the lower Bollinger Band is. In the wheat market, again, no trend. In fact, in corn, you don't have a trend. You have the higher high and lower low, by the way. You don't have a trend here either. You got a higher high and lower low. This makes sense in the sense that so many traders, even though it's a wheat or a corn market, it's a world trade market too. What does it mean for everything? And that's what I see. The bias is down. You're oversold as can be. The lower Bollinger Band, this black dashed line, was hit here. This is, I'm just using an arrow to point up that the market eventually made a higher high. But the first challenge was it. That was the last time you hit a Bollinger Band, and Bollinger Bands failed up there as well. I see a trading affair that's more a day trader's delight than it is a trending delight. In the sugar market, sugar seems to be coming to life again. Now, it is overbought. Each time it's gotten up to these Bollinger Bands, it's run into a problem. I have no reason to think different, but I'm also watching something that's interesting. You can see how narrow these bands have gotten. Now that the market's challenging them and getting out of them for the first time, I think tomorrow's going to be an important day. If the market fails, okay, it's more of the same thing. There's no reason to be bearish because you've got higher lows, higher highs. The question is, in an overbought condition and getting back to the Bollinger Band the second day today, because you hit it on Friday, were the pros doing anything in the market? In the coffee market, I'm nervous about, as I've told you, I've been nervous about coffee for about a week now, because I realize that as soon as people go back to work, those coffee shops are going to open in China. And as they open, the demand comes. In Cameroon, the harvest season is over. The bids are coming in. The prices there went up over the weekend. So I was watching that as well. I'm not a bottom picker. I don't care where a top or a bottom forms. It's after the fact. Keep your eye on this Bollinger Band, rather the slow stochastic. If it turns up, because we had hit the Bollinger Bands and stayed with them, and now we're going sideways, this market could be at the inflection point where enough damage has been done and maybe the market's found an area of value. Cocoa market, up too. What's going on? All the softs are up. That's another thing that's got my attention. They're up, and other markets are having a lot of problems. In the cotton market, I think I would have felt a lot better today had cotton been able to get over 68.42. I would have then been able to be more confident. But I'm still fairly interested here. Cotton up, softs up, higher lows in the cotton market. Now, the last high was 68.42. I have the swing line here that I'm showing to the upside, but really needs to get through that number to get me confident of this pattern. Just an interesting day today. It's got me thinking about what's going on. Now, the meats will throw you back to the other side. They're all still failing. You have a bearish embedded reading. That means that the two numbers to make up the slow stochastic are under 80 and still pointing sideways to lower, under 20. That's a selling recipe, I still think, for the pros. When you lose that reading, it'll be a sign that the market's ready to give you a bounce, maybe a sizable one. In the feeder cattle, it's the embedded reading, so the rallies are still getting sold. We'll see if the market can break out here to the downside. And the hog market went nowhere today. So meats aren't getting the play, but hogs did something I still like. If we come back here to hogs, this was the close of business on Thursday the 6th. And if we look at the numbers, the stochastics were still embedded. They lost that reading on Friday, and they kept it lost today. That's often. You can't get it back now. You have to go through the 3-day process to do it again. Therefore, this puts into what I call play the lost embedded play. It's where momentum has been lost to the downside and price often makes a run at the 18-day average of closes. It's certainly contra trend, and there is no trend right now. You've got the swing line up, but you got the bias down, and momentum is turned up, and you cannot just make it lay down again without going through a whole 3-day process, which couldn't even begin tomorrow. So it would be a very difficult feat. We'll see what this market wants to do. But as I said, I think this is a day trader's delight. And if you're an in and out trader, one of the tools that a lot of traders look at are pivot points. You know, people use so many things, I could never say they all use any one thing. But I've created a 3-part video. First, I explain the formula of what it is, the popularity of it. And I'll walk you through how it exactly occurs, teach it to you. You'll be able to do it, but you don't have to plot these out. I'll show you how to colorize these and put them on your charts in another example. But you're going to see where the resistance points are, what is the pivot, where's the support points with it. The next part that we go to is looking at the different resistance, support, and then I'm going to teach you not only how to put it on your chart, but now how to use the slow stochastic with it intraday. And it's not on a day chart. You're going to use this on an intraday chart, and I show you how to do all that. If you're interested in learning this, it's free. I've created the videos. Go to our website, sign up for them under the free offers, or call my staff. They'll get them to you. I'm Ira Epstein. You have a good day.